All right, heroes, we're back. We're talking about another one of our pretty simple, very straightforward setups. There is an expectation that you've come here to this specific lesson, to this specific video, for this specific setup, that you do know how to buy and sell stock. Hopefully, you know how to do it in the TD Ameritrade or Thinkorswim platform. If you don't, hopefully you know how to do it in whatever other trading platform you have. Now, if you don't know how to buy or sell stock, I highly recommend you go to the first video in this little section, which shows you how to navigate through at least the Thinkorswim platform to actually be able to buy stock. So if you don't know how to do that, you're really not going to get that much out of here, because as soon as we're done with this 10, 12, 15-minute video, however long it goes, you will be able to start doing this immediately. So this is the 8 days a year setup. And there are 8 specific days every single year that actually are really profitable. And the funny thing is, and we'll show you later on in our study, it's been going on for almost 30 years now. That's how much we were able to backtrack this data. So what's going on with this? Well, 8 days a year setup, the FOMC. Well, the Federal Open Market Committee is known as the FOMC. And this is a committee inside the Federal Reserve System, right? And they're charged under the United States law with overseeing the nation's market operations, i.e. the Fed's buying and selling of treasuries. Okay, there's a lot in here. Let's break it down. The first part is the Federal Reserve System. The Federal Reserve System is a banking system that is an independent entity that does not have any oversight by the U.S. government, who is the sole entity that is allowed to create money, create currency. And what they do is, if the United States needs to borrow money, they add a couple of decimals on a spreadsheet, and they create money and charge the United States interest for doing that. Okay, so there's an FOMC committee within the Federal Reserve System that oversees a lot of the nation's market operations, which includes setting interest rates, at least the overnight interest rates. It also includes doing things like the buying and selling of securities or treasuries. So this is, if you don't know what the Federal Reserve System is, they're the puppet masters for the entire global economy. Now, I don't mean to scare anyone by that, because there's a profitable setup to be found and to be used based off of what they do, but they are the puppet masters. They're the ones that could get to very much control a lot of the supply and demand based off of interest rates and based off of the buying and selling and liquidity in the actual market. Don't worry too much about that. We're just going to use the words FOMC and the Fed and announcements throughout this little video here. So I just want you guys to have an understanding of what it is. And yeah, it looks like that on the right. There are 30, 40, 50 academics. None of them have ever traded before. None of them have ever made a single investment before, that get to decide monetary policy for the United States and pretty much the entire world, because the United States leads the rest of the world. So we wanted to do, and again, if this is the first video you're watching, it really shouldn't be. But if it is, and you know how to buy stock, I guess it's okay. And what we do with every single one of our setups, every single one of them, they're backed by many, 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 many years of data. Now, the reason we do that, and it's very expensive to me, and that's great and all, and I have a lot of people who are helping out with it, but the reason we do that is because we don't want the market to be this emotional thing. We don't want the market to be something that we keep on changing our minds, keep on changing our philosophies. If we have data back anywhere between 10 and 50 years that a setup works, that will give us a lot of confidence that when the opportunity presents itself, we can actually act upon it. So we do studies for every single one of our lessons for that reason. Now, the results in the future might not be the exact same as the results in the past. However, again, it's all about giving you that confidence, so that when an opportunity, one of these setups presents themselves, you'll be able to jump on that, because you have the confidence and the backing of anywhere between 10 and 50 years of data. So what we did was we did a study from 1994 to present. So 23, 24, 25 years of data, depending on when you're actually watching this video, and we did it in the S&P 500. So what is the S&P 500? The S&P 500 is the stock market. So when people talk about the market is up, they're talking about the S&P 500 being up. When they say the market is down, they're talking about the S&P 500 being down. The S&P 500 is an index that is a basket of 500 primarily US-based stocks and US-based companies in many different sectors. So there are healthcare companies, there are agricultural companies, there are technology companies, there are financial companies, there are oil producer companies. So there are companies in the S&P 500 from all different sectors, all different categories, and that gives you a good overall understanding of what the stock market is doing. The S&P 500 is the number one index in the world that traders and professional money managers not only look at every single day to get a gauge of what the market is doing, but at the same time peg their performance to that. And if you guys have seen our daily setup, buying at 330, selling at 345, the reason that that happens is, again, because all these mutual funds, all these low-cost index funds, they want to peg their performance as close to the S&P 500 as possible. So that's what we ended up doing. So we did a couple of things. The first thing we did was back in 1994, the first trading day in 1994, we bought the S&P and held the present. And obviously, if you've done that, you've done really, really well for yourself. It might have taken 23, 24, 25 years to make money, but you've made money. So job well done if you bought the S&P 500 back in 1994 and held till present. You definitely had to close your eyes and hope for the best in a couple of the big market crashes. But if you didn't and you prevailed, hats off to you. And then what we did was we compared the S&P holding, just buying and holding, to removing the 24-hour period before the 8 FOMC announcements every single year. So I think I actually went a little bit ahead of myself. What they do when the Fed, when the FOMC, when the Fed, they decide interest rate policy or how many US treasuries or securities they're going to buy or sell, they have a meeting 8 times a year, right? This is like this FOMC meeting. They have these meetings 8 times a year. And at the end of those meetings, at 2 o'clock on the last day, 2 o'clock Eastern time on the last day of every single one of those meetings, they come out with an announcement of what they're going to do. It could be an announcement of what they're going to do with interest rates. It could be an announcement of what they're going to do with purchasing securities. It could be an announcement of what they're going to do with the buying or selling of treasuries or corporate bonds. So there's a lot that they could come out with. But on the last day of these meetings, and these meetings usually last 2 to 3 days, at 2 o'clock, they come out with some sort of an announcement. So I went a little bit ahead of myself, so I want to apologize for that. But that's why we compared the S&P 500 buying and holding from 1994 to present, and we compared it to doing the same thing, except we're removing the 24-hour period before those 8 announcements. So if the announcement was on a Thursday at 2 p.m., we would remove the Wednesday from 2 p.m. all the way up to Thursday at 2 p.m. to see those actual results of buying and holding the S&P 500 minus these 8 FOMC announcements every single year. And again, these FOMC announcements could be a lot of different things. However, the market very much anticipates and is very much looking to see what's going on because, again, the Fed is very much like the puppet masters of not only the economy, but the stock market too. So let's kind of take a look at the results. So what we can see in the gray line is, hey, if you bought the S&P 500 in 1994 and held to present, and it looks like this study only went up to the beginning of 2017, but regardless, if you bought at the beginning of 1994 and you held to present, you would have made money. That's fantastic. Congratulations. For those who did that, that is fantastic. But what we can see in this orange line here is the buying and holding of the S&P 500 without those 8 24-hour periods, without the 24-hour period 8 times a year before those FOMC announcements, right? That's what we said. And when you remove that, you get significantly less returns. Very, very interesting. And in fact, what's really crazy is it's very, very significant, and it continues to be more and more significant as time goes on. And at no point since 1994. At no point since 1994 has it been less effective or less profitable to keep those days. So clearly looking here, when you remove the days, you are more profitable. And there has never been one point in those last 23, 24, 25 years where that was not the case. And we break it down by the numbers, this is when it really gets interesting. So if you bought and hold from 1994 to, I guess, the beginning of 2017, you would have made 420% your money. So again, the people that did that, amazing, amazing. But if you bought and hold the S&P 500, which again is the overall stock market, and you removed those 8 FOMC days, which is the 24-hour period 8 times a year before the actual announcement, you would only have made 268%. So when we look at the gains, if we look at the gains that are provided just by the 24-hour period 8 times a year before an FOMC announcement, you're looking at 36.15% of all market returns since 1994 and coming in those 8 days a year. Let me repeat that. If you take the buy and hold strategy of the S&P 500, you would have made 420% of your money, which is phenomenal. If you bought and held and was not an owner, right, and you subtracted the 24-hour period before all FOMC announcements, you would have only made 268% of your money, which is still great. But what this means is 8 days out of the year, the 24-hour period before the FOMC announcement, which is at 2 o'clock Eastern Time, the last day of all these FOMC meetings. If you had just traded those, you would have gotten 36.15% of all market returns. Let's visualize that a little bit better. So what you can see here on the right side, from 1994 to the beginning of 2017, there were 5,734 days. There were 5,374 days that got 63.9% of all market returns. However, there were 188 days. 188 days that got 36.2% of all market returns. And again, we've been doing this since 1994. This is since 1994. So this is not curve fitted whatsoever. This is absolutely not curve fitted whatsoever. It's a very, very big sample size. So what we can see is in 3% of the days, these 24-hour periods before these FOMC announcements, right, we get 36.2% of all market gains. So you get a little bit more, over a third of the results in 3% of the time. That's the power of this 8 days a year setup. Now, how do we go ahead and do it? Well, pretty simple. We're going to go to the Federal Reserve's website. We're going to actually see when they have these announcements. And don't worry, because we have notifications and we have notifications in Market Hero to actually let everyone know when these setups are going to happen. So don't worry too much if you don't want to go to that website now. But if you wanted to do it on yourself and not just wait for notifications, this is what you do. What you end up doing is you want to go to the stock SPY. So we talked about the S&P 500 being the overall stock market. You cannot go ahead and buy the S&P 500. There's no stock that you can buy that's the S&P 500 outright. But what you can do is you can buy the stock with the symbol SPY. SPY is the stock that it gets the exact same price movement as the S&P 500 for just 1/10 of the price. So any movement that goes on in the S&P 500 goes on in SPY. And our video about how to actually buy and sell stock uses SPY as the example. So what you're going to do is 24 hours before an FOMC announcement. So if the FOMC announcement comes at a Thursday at 2 p.m. Eastern Time, on Wednesday at 2 p.m. Eastern Time, we're going to go ahead and buy that SPY stock. And again, because SPY gives us the exact same price movements as the S&P 500 for just a tenth of the cost. That's all we're going to do. And then on the day of the announcement, right before the announcement, 158, 159, we're going to sell the shares that we bought the day before. And we're going to rinse and repeat that. Now, a lot of you are probably saying to yourself, why does this happen? There is a why. There's totally a why this happens. But the reality is, again, the why is not as important as the what. The what clearly visualized here is in 3% of the days, which is the 8 days a year, the 24-hour period leading up to an FOMC announcement. In 3% of the days, you get 36.2% of the results. That's just 8 days a year. So if you wanted to do this as your only setup, you'd just be trading 8 days a year. So again, the what is very, very important, is the most important here. The why, I'll fill you in on the why. Typically, people believe that the Federal Reserve and the FOMC, they're there to support asset prices. They're there to support the economy. They're there to grow the economy. And if that's what they're actually doing, people buy beforehand because they're excited about the possibilities of what the Fed could do, again, to help grow the economy, help keep the stock market up, lower unemployment, all of that stuff, buy US treasuries, fund the government, all of that stuff. So in anticipation of the Federal Reserve coming out in their announcement and saying, okay, we're going to do this, this, and this to support the economy and to lower unemployment, people buy into that because they get hopeful, they get excited. So it's kind of like a buy the rumor type of thing. So this is going back since 1994, guys. 1994. So this is not curve fitted whatsoever. And as we can see pretty clearly here, again, the 24-hour period, 8 times a year before those 8 FOMC announcements, which is just 3% of all trading days, get 36.2% of all returns. So you guys will get notifications about these setups, so don't worry about it too much. But if you want to go ahead and do it yourself, you're going to go to the Federal Reserve's website, and then you're going to, 24 hours before that announcement, you're going to buy, and then right before the announcement, you're going to sell. If you guys have any questions, let me know. If not, I'll see you guys in the next video.